Hey everybody, Mike Angelo here. We are back talking about returns on a multifamily investment opportunity. So just an example, high level, want to talk a little bit about the terminology that you should know as an investor if you're thinking about investing in multifamily. All right, so we're going to still use that 100-unit example. This is a property that we've already vetted the operator. We really liked the operator. We like their experience. We like what they're doing. We looked at the market. We see all the right dynamics that are happening in the marketplace. We like the location. We've checked it out online. We've gotten reviews. We like those three things. The last thing, if you recall from the last video, is what are the returns? So this is what's being projected. A $100,000 investment. We know it's a 5-year projected hold. So for 5 years, my investment will be illiquid. It'll be parked inside of this asset. The goal is for them to sell it at year 5, which is a very normal process. We're looking at a projected 5% cash on cash. What is cash on cash? Well, that's the cash flow you can project to expect coming in every quarter, sometimes every month. The total number on that per year, if I just take 5% into 100,000, is $5,000. I'm going to attempt to write neatly per year. So I can earn $5,000 in cash on cash or cash flow per year. For 5 years, $25,000. Right, pretty easy. So 25,000 is what I'm going to earn in overall cash on cash. Then you have some stuff over here, 16% return. This is AAR, average annual return. So every year I should average about 16% or $16,000 in total return per year for 5 years. Now, there's another term out there called IRR, internal rate of return. We're not going to get into that in this video. These two are related. They're kind of cousins in a way as far as how returns are calculated. This gets a little bit more complicated and it factors in the time value of money. For simplicity's sake, we're going to just use AAR, average annual return. Reach out to us if you have more questions on IRR. So 16% return. Let's just do the math on that. 16% on 100,000, I should earn $16,000 per year in year 1, year 2, year 3, 4, and 5. So 16 per year. That totals $80,000. So $80,000 is what I'm going to expect to earn on my total investment. But part of that was my cash on cash, if you recall, and we figured out that that was $25,000. So this $80,000 is broken into 2 parts. $25,000. And we erase this just so you guys have a bit of an example. 25,000 there. But remember, we said at year 5 it's going to be sold. So your portion, $100,000, you have an ownership portion when that property is sold. The profits that are coming from there, your projected profits are $55,000. And I came up with that really simply is this is the total of 80,000. So this is our cash on cash. This is our equity. Sorry about the chicken scratch writing. Total is $80,000. So you invest 100, we give you back 80. Don't forget, we also give you back your principal. So now it comes into the next portion of the conversation is what is the equity multiple? It's another way to look at investments in the long run. Your equity multiple ranges, again, completely example, 1.5 to 2.0x. That means 150% to 200% of your investment is what you can see on a typical deal. Depending on the kind of deal, depending on the operator, there's lots of different factors that go in. But let's use this $80,000 example. I had my 100K that I originally invested. I get that back in year 5. I get $80,000 as a return, combination of cash flow plus equity. Remember those two together makes it $180,000 or 1.8% of my original 100. So this property or this project would produce a 1.8 equity multiple on this $100,000 investment. Now, let's just say, hey, I don't have 100K. I have 50K. Does that change it? It actually doesn't. Now, does it change the numbers? Sure. Doesn't change the formula, though. Just cut this in half. Your investment would still produce a 1.8x, and your returns would be just half of that because, again, cut $50,000 in half. It's the same percentage of return, still 16% return. It's just half of that number. So that is a great way to think about how you look at and analyze returns on investment. Again, keeping it super high level, important to know cash on cash, important to know returns. Why is there such a big range, you might ask? It depends on the operator, depends on the project. On an existing apartment building, value add, this is fairly common. On a ground up development deal, which they are out there and they actually usually produce much north of a 2.0x, usually 2.2 to 2.5x. Why is that? Because there's no cash flow typically on a ground up project. You're not going to see any revenue coming in because the project is being built, the apartments are being built. But once they do sell, then the returns are pretty fantastic because they have a pretty low basis when they build it. So lots of different ways to look at it, but like, subscribe, please comment in the comment section below if you have any questions. Cheers.